All right, let's talk about a company that's probably on every industrial investor's watch list. Atlas Copco. You know the type. A true giant, a best-in-class global leader. But, and it's a big but, it always seems to trade at this sky-high price.
So that's the big question, right? Is this powerhouse really worth that premium price? I mean, we all know it's a fantastic company, but does the valuation actually make sense? That's the puzzle we're going to try to solve today.
And to answer that, you can't just look at a stock chart. Nope. We've got to pop the hood, see what makes this thing tick, and what you find is that it's not just one business, it's four.
So yeah, it's really a collection of 4 different businesses under one roof. But just look at this. One of them is the absolute heavyweight. We're talking about Compressor Technique. They make industrial air compressors. And man, they are the core of this whole operation, pulling in a massive 44% of the revenue.
And get this, it's not just the biggest, it's also the most profitable. We're talking an operating margin of nearly 25%. I mean, all 4 segments are pulling their weight for sure, but the real financial engine room, yeah, that's in the compressor business.
Okay, so to really get what's going on here, we have to zoom in on 2 of these segments in particular, because this is where things get really interesting. There's this internal push and pull that pretty much defines the whole company.
The best way I can describe it is like this. You've got the engine, and then you've got the roller coaster. The engine, that's the compressor business we just talked about. It's a beast. Stable, massive, and just reliably prints money. But then you've got the roller coaster. This is their vacuum business, and it's tied directly to the wild world of semiconductors. So yeah, the growth potential is huge, but wow, can it be a bumpy ride? And listen, this isn't just some theory. It's very, very real. Just last year in 2023, the semiconductor market took a nosedive and bam, orders in the vacuum segment fell by 20%. And that's an organic decline, meaning it's pure raw demand just drying up. It's the perfect example of how that roller coaster can suddenly plunge downwards.
So you might be thinking, okay, hold on. If one of their main growth areas is that unpredictable, how in the world does this company stay so stable and command such a high price? Well, that's where we find their secret weapon, their hidden moat.
See, Atlas Copco has built these incredible walls around its business. First, they spend a ton on R&D, so they're always ahead on tech. Second, their brand name is gold. People trust it and will pay more for it. But the real kicker? It's their massive global sales and service network. You just can't build something like that overnight. It's almost impossible for a competitor to copy.
And that service network, that is the secret sauce. Check this out. A whopping 37% of their money doesn't come from selling a big new piece of equipment. Nope. It comes from the so-called boring stuff, service contracts, spare parts, maintenance. It's sticky, high margin, and it comes in year after year.
This right here is the key that unlocks the whole thing. The analysis says it perfectly. This service business creates a stable, predictable stream of cash. It's the shock absorber for the whole company. To go back to our metaphor, it's the safety bar that locks you in on the roller coaster.
So let's recap. You've got the stable engine, the high growth but bumpy roller coaster, and this huge service business acting as a safety net. So what does that all add up to when you look at the financials? Well, the results, they really speak for themselves.
Just look at the revenue growth. They went from around 100 billion Swedish krona back in 2019 to over 172 billion in 2023. I mean, think about what happened in those years. A global pandemic, insane supply chain issues, and they just kept growing. That tells you the model is incredibly resilient.
But revenue is just one part of the story. For me, this is the number that really pops. A 30% return on capital employed. Let's break that down. It means for every single dollar they put to work in their business, building factories, developing tech, they get 30 cents back in profit every year. That is just an incredibly efficient, value-creating machine. And that is why people are willing to pay up for this stock.
Okay, so now that we've seen the engine, the roller coaster, and that all-important safety net, let's bring it all back to you, the investor. It's time to put it all on the scales and look at the bull case versus the bear case.
On the bull side, you have these unstoppable long-term tailwinds. Seriously, things like energy efficiency, smart factories, the whole green transition. All of these trends are screaming for the exact kind of high-tech gear Atlas Copco makes. But on the bear side, you can't ignore the risks. That semiconductor cycle we talked about can be absolutely brutal. They've got a lot of exposure to China, which is slowing down. And hey, even something as simple as a strong Swedish currency can take a bite out of the reported profits. So at the end of the day, it all boils down to this one single question you have to ask yourself. Do you believe that the incredible long-term promise of these global megatrends is strong enough to outweigh the very real and sometimes painful bumps you're going to hit from those short-term cycles? And that, right there, that's the Atlas Copco dilemma.